Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the maiden voyage of the podcast. By way of background, for those of you who aren't familiar with me, I spent over 20 years in the hedge fund business. I worked as an analyst, I was a portfolio manager, and I was a partner at a several billion-dollar hedge fund for many years. Throughout my career, I invested on both the long and the short side, though I have to say I was a very active short seller throughout my career. And I did everything from sniffing out companies that were bilking unsuspecting students in the for-profit education sector to researching a company that was involved in the natural resource space that was touting a technology that had just no prayer of working. You name an industry, and I probably have looked at it with the exception of biotech and bank stocks. Biotech, way too complicated for me, and bank stocks just way too opaque. The balance sheet's too opaque. And throughout my years, I traveled a ton, and I looked all over the world looking for profitable investment ideas. It took me to a lot of nooks and crannies. I looked at market caps from the tiniest micro caps all the way up to the biggest mega caps. And I had some good success throughout my career, but I also had my share of failures. I definitely say the wins are more personally gratifying. But I think the bad investments were probably the greatest teachers. I mean, there is absolutely nothing like getting your head handed to you by Mr. Market to teach you a valuable lesson. And it happens, talking about that, I can't make any promises as we start this journey with the podcast except one. I can promise you that from time to time I'm going to be wrong. That's just investing. It's not from lack of research. It's not from lack of effort, but sometimes the market's just so humbling. Or just sometimes your thesis is plain wrong. It happens. But and I think the important thing in investing is when your thesis is wrong, you don't have thesis creep, right? You don't look for a reason to stay in an investment. You say, I'm wrong, and you move on. But the goal of the whole podcast here is what I want to do is help you navigate these financial markets and help you look for profits and educate you so that you can level the playing field against the professional investor. I listen to a lot of podcasts, and there are some really terrific ones out there. There's some very fascinating topics, really brilliant guests that come on. But a lot of these things are geared towards the professional investor. I listen to them and the hosts and the guests. Fascinating, but they talk a language really that only a very financially sophisticated amateur or professional investor would be familiar with and even find useful, right? Very complicated subjects. They delve into, really complex financial concepts, and the discussions are often laced with Wall Street jargon, funky acronyms, so much detail that unless you do this every day, it's really tough to follow along. And all of that's great, right? For those who invest for a living or extremely experienced amateur investors, but it doesn't help regular, everyday people who are trying to invest on their own. It could complicate it more than it could help them, right? So think about this podcast as the exact opposite. What we're going to do is I'm going to take these same subjects, but I'm going to break them down to their most simplest form. I'm going to explain them in layperson terms. I'm going to help educate you and hopefully leave you with some knowledge that can be part of your investing toolbox that's going to help you make some informed decisions. So I want you to think about the time you listen to this podcast. Think about this like you're heading down to the bar. You're going to go to the bar, you're going to sit with some friends, you're going to have a beer, and you're going to talk shop, right? It's a podcast for us regular guys, regular folks. And I'm as regular as they come, right? I was raised by a blue-collar Italian immigrant grandparents. My grandmother was a seamstress. My grandfather was just a tough-as-nails longshoreman on the docks in Brooklyn. That's the stock that I come from. And what I'm going to do is I'm going to talk and take complicated subject matter, break them down to easily digestible information, and hopefully level the playing field. So it doesn't matter. You sell heavy equipment to demolition companies, you design medical devices that save people lives, or you bake bread early in the morning for that bakery you own. If we were sitting at the bar, you'd explain to me what you do, how you do it in a way that I could understand. I'd ask some questions, right? And I'd come away probably a lot smarter about what you do. That's how I'm going to break down the investing world for you. We're just sitting around having a beer, talking investments. It's going to be digestible. It's going to be understandable. I'm going to demystify all the complicated Wall Street nonsense. And I'm also going to share with you not only what it is, but why it's important and how to think about generating profitable investments from it. So here's what to expect from the podcast as we go forward. It will be weekly. I'm going to bring you information and ideas that you are not reading about in the mainstream financial press. We're going to spend a lot of time talking about where the puck is going, not where it is. I played hockey from the time I was 5 years old, played all the way up through college, and I still play to this day. I've lost a couple of steps, but we'll keep that between us. But I'm sure many of you are familiar with Wayne Gretzky, arguably the greatest hockey player who ever played. And if you watched Gretzky play and you saw him on the ice, you'd see that he wasn't particularly big. He maybe stands 5'11". He was thin, not very fast, didn't have a great shot, but he holds all scoring records. And people ask him, how do you do this? And he said, well, kind of easy. He said, most people skate to where the puck is. I skate to where the puck is going. That's just another way of saying he anticipates. So the stuff I talk about is either going to be under the radar or it's going to be hiding in plain sight. But it's focused on ideas and thoughts that aren't being discussed. And if it's not being discussed, it's likely not priced into the stock. A lot of what I do focuses on finding inflection points in companies, industries, where the existing narrative is so overwhelming, the fundamental changes that are taking place below the surface and are being completely overlooked by most investors. That's where you can really capture some significant upside with patience, right? If it's not being talked about now, you have to have some patience. And we're going to talk about that at the end of the podcast. We're going to talk about time and how it's a benefit. You can use it in your favor. So with that, my guest today is a CEO of a company in an industry that I think offers the best risk reward I've ever seen as an investor. It is one where the fundamentals are absolutely changing, yet the overwhelmingly bearish narrative is obscuring those changes. It's an industry that's mired in a 7-year brutal bear market, an industry where the number of companies participating has declined from over 500 at the peak 7 years ago to about 40 or so now. It's an industry whose underlying commodity price is down well over 90% from its peak. It's also an industry whose bear case is so dated and long in the tooth, but whose bearish narrative still has a grip on the sector, despite fundamentals that are dramatically improving. It is an industry that is absolutely at an inflection point, I believe, that is hiding in plain sight. So with that, let's get with my interview of Jordan Trimble, Director, CEO, and President of Skyharbour Resources, which is a junior Canadian uranium exploration company. Jordan Trimble, welcome to the podcast.
Thanks for having me.
It's good. It's good to talk again. I mean, I think we saw each other just a couple of weeks ago when I moderated the Vancouver Resource Investment Conference panel, where I had you and a few other uranium CEOs up on the stage talking uranium.
It was a good panel. It was a little short, but it was. I think we got the salient points in, so it was good.
Yeah, we could have used some time. So some more time. So, Jordan, it's funny. One of the things I meant to put up when we were speaking, I should have put a slide up because there's a quote that I like to use, and it's from Howard Marks, who's the co-chairman of Oak Tree Capital, one of the great distressed investors of all time. And he says, in the search for market inefficiencies, it helps to get to a market early before it becomes understood, popular, and respectable. There's nothing like playing an easy game, an inefficient asset class, where the other investors are few in number, ill-informed, or biased negatively. That's far easier than trying to be the smartest in the game that everyone understands and is eager to play. So I think I could just take that all out and put the word uranium in there.
I was going to say that sums up the sector very, very nicely.
So, uranium has been mired in just a brutal bear market. It has been 7 years now since the uranium sector was turned upside down. The whole nuclear power fuel cycle, the nuclear power industry, was turned upside down on its head post the nuclear meltdown at Fukushima in Japan in March of 2011. And that created quite a domino effect, a slowdown in demand, not growth in reactors, but Japan being 13% of nuclear power demand, when that went offline and stayed offline for many years, and most of them still are, it has really created a backlog and excess supply in the market. I was saying earlier on the podcast, we've gone from 500 companies that were, mining uranium to now, about 40. So if you can, give me your view on this time. You give us give a little background on you, and then get the listeners up to speed on where you think the industry is right now.
Okay, sure. So I run a company called Skyharbour Resources, which I founded about 4.5 years ago now. So post Fukushima, we were looking at opportunities in the uranium sector, much like yourself. We saw really what was becoming an unprecedented opportunity to go in and basically lay the groundwork and build a base, if you will, for a turnaround in the market after really what was a black swan event that's more or less crippled the industry. And if you're familiar enough with the natural resource space, the mining industry in particular, it's very cyclical. It's boom and it's bust. It's always been that way. It always will be that way. And uranium in particular seems to go through these hyper cycles, if you will. We've seen this in the past, and you can get these long drawn out bear markets as we've suffered. But when the market turns, and there's a number of reasons for that with each new bull market, and again, I think we're coming into one here sooner than later. The uranium market has a tendency to turn very quickly, and when it does move higher, it moves much higher. We saw that in 2006, 2007, when you had the spot price move from $20 a pound to over $130 a pound. The equity returns for investors were multiples of that. So it's an exciting space to be in when you see that kind of price action. But the reality of it, and much like you summarized in that quote, is you have to be there in the early days, right? It's very easy to miss that quick move up. So with Skyharbour, what we've done is, just the kind of in a nutshell, we've gone out there and we've had the mandate to acquire projects and assets in the number one mining jurisdiction and the highest grade depository of uranium in the world, which is in northern Saskatchewan, Canada. It's called the Athabasca Basin. These are actually the richest mineral deposits you can find on a per ton basis. It's really unique part of the world and jurisdiction. And we've gone out over the last several years and basically built a portfolio of projects, of uranium projects that range from earlier stage exploration to more advanced stage exploration. We really focus in on that first part of a mining company's life cycle, where you can generate the most significant returns upon making a discovery, delineating a resource. And we also see that fitting into the broader uranium market cycle here. The worst thing right now is if you're actually producing uranium, because you're producing it at a loss at almost any mine globally when you look at it at an all-in cost. So our thinking is, why not go out there and look for new, higher grade, potentially lower cost deposits, so that when we do come into this next uranium bull market, we'll see a significant price appreciation with the share price and with our valuation. So we've acquired 5 projects, 2 of which are advanced stage exploration projects, one of which has high-grade uranium mineralization. We're delineating a resource there now as we speak. Another one has an NI 43-101 uranium deposit, and we have a couple of other projects as well that we're bringing in strategic partners in to fund exploration and fund development on. Our largest shareholder is a company called Denison Mines. It's a New York-listed company, one of the larger uranium companies out there. They own about 10% of the company, and the president and CEO of that company sits on our board. So a very close and strategic partnership with Denison. And then we also have France's largest uranium mining and fuel processing company called Areva earning in on a project that we have in the Athabasca Basin as well. So partners at the project level. So we have a couple of notable strategic partners, a large land package, and we're actively exploring, advancing, and developing these projects, creating catalysts for the investors, for the share price going forward while we come out of this this significant bear market. And I do think I will start by saying, I do think we've seen a bottom put in place. I think we saw that in late 2016 when the price of the commodity broke through $18 a pound. It's since recovered slightly, but it's been consolidating, and it's been trading range-bound here in kind of the low to mid-20s. And as you're well aware, there's very few mines, if any, that can turn a profit at this price. So it's a real unique situation, and one that I think is going to create a notable bull market over the coming years.
So, Jordan, it's my 14-year-old daughter came home the other night from religion class, and she said she's getting her confirmation, and she said, "Hey, Dad, Pastor Ian said we should own some Bitcoin, and how much do we own?" And I said, "Well, we don't own any, honey." She said, "But I thought you're a smart investor." I said, "Well, thank you, but I guess, but we don't." She said, "Well, that's not very smart." So I laughed, and she said, "How does uranium do, right, versus Bitcoin?" And I said, "Well, honey, that's a topic we'll discuss another day." But right,
I'd like
so
to see
so
the
your
research,
kids
the
can,
correlation
yeah.
on it.
But so when I talk about uranium with my friends and with people who are not familiar with it, it's this obscure, funky thing, and people will say, "Well, so what is uranium? What's it do besides nuclear bombs?" And you explain to them that 95% of all uranium pulled out of the ground goes towards nuclear power, and then you get that pickle, scrunchy look face, and they say, "Nuclear power, isn't that dead?" And it's so fascinating to me because I just want to talk, if we can, about nuclear power, because here is a form of electricity generation that is clean, it's safe, it's emission-free. It's about 11% of the global electricity supply. It supplies in the U.S. 20% of the electric grid. It's about 23 million homes. It's baseload power, so it operates 24/7 versus some of the intermittent powers of the alternative energies like wind and solar, although that is improving with battery storage technology and costs coming down. So you've got a clean air problem around the rest of the world, and this provides zero carbon, zero air pollution. You've got hundreds of billions of dollars globally committed to it, and at the end of the day, what you have is an industry that nuclear power is a growth industry, but yet you have the uranium mining industry, the feedstock for nuclear power, with the commodity down 95%. So you have this dramatic disconnect between the end market growth and the resource that goes into fueling the end market growth. So, I mean, how do you think about this as the CEO of a company that's in the exploration business? So you're out looking for resource, right, to build a company, yet you have an end market that has not yet turned, right? And we'll talk in a little bit about why I think it's happening, and you could comment on that. But how do you manage being in a brutal bear market to look to grow a company in a resource space that is in a market that's on its knees?
Yeah, no. So the way we view it is, we believe there's a recovery coming. As I pointed out, I see that happening here over the next few years, and being an exploration or early stage development company is, I think, exactly that's the sweet spot right now, if you will, right? Because you're able to basically build an asset base and not just the assets, the projects, but also the team, right? There's a lot of good talent out there that has been looking for work or just isn't employed anymore because of this drought that we've been in. So
it's a buyer's market for talent.
Exactly, very much so. And as you know, in this industry, it's people is a very important ingredient for success. So it's basically it's a buyer's market, like you say, and you're able to go out there and, like I said, build lay the foundation for the next market as an exploration or development company right now. And so getting back to the nuclear industry, right? And everything you said is absolutely true. It's this industry that's been tainted, if you will, and I notice it specifically here in the Western world. And I think it's important to differentiate, when we talk about nuclear in the Western world versus when we're in Asia, when we're in parts of Africa, the Middle East. The view there and the perception there is different, right? So this is very much a more of a Western narrative. I was in China late last year, and let's not forget that China is the real growth story here in nuclear. If you look in 2016, which just so happened that more nuclear electricity generation came on the global grid than any year in the last 25 years. So yes, it is still very much a growth story. You have 57 reactors under construction globally. You have hundreds more in the pipeline that are being proposed or planned. But a good chunk of these are in China. The 10 reactors that came on in 2016 alone, half of them were in China, right? So you got China, you got India, parts of the Middle East, parts of Africa, parts of South America, even Southeast Asia, where they're going nuclear. And as you said, nuclear provides baseload, CO2-free, low-cost energy and electricity. It also provides grid and price stability, right? That's I think an important point here. When you see the price of coal or natural gas, other baseload electricity sources increase, right? That has a significant impact on the bottom line of those utilities companies operating those power plants. When you see the price of uranium increase, right, it doesn't make a huge difference to a nuclear utility's bottom line. The fuel cost of a reactor is less than 5%, which is good because you get that price stability, and that's important. It's 24/7 as well, right? You don't need the sun shining or the wind blowing. It's a reliable form of electricity generation. It has been for many decades, and it will for many more decades. And as you point out, look, a lot of the 11% of global electricity generation is nuclear, and in certain countries, the U.S., 20%. Take France, for example, over 70% is nuclear. It's one of the cleanest countries in Europe, in the world for that matter, developed countries, because it has clean electricity and relatively cheap electricity as well. So nuclear is here to stay. It's growing at a steady clip, and it's also important to note too that when a reactor is built, it's a big infrastructure spend. It's a significant project, and these reactors don't run for 5 or 10 years. They run for 50, 60, 70 years. You look at some of the new reactors that are coming online, the Gen 3 reactors around the world. These are big infrastructure projects. They consume a lot of uranium. They'll last for many, many years. It's not easy turning these reactors off either, right? That's the other thing. There's this narrative out there that reactors are being shut down at an unprecedented rate. The reality of it is that there is still growth, especially in certain parts of the world, like China, like India, and you don't just simply turn the light switch on or off with these reactors. So nuclear is here to stay. It provides lots of jobs. It anchors local community economies and tax bases. It's been an important part and driver of economic growth in the developed world, providing that cheap, clean electricity. It will do that now in the developing world. And if we just talk about for 1 second the Paris Climate Accord and Agreement, and this is, I think this is an interesting point to make here. They ran a whole bunch of scenarios to basically, bring down carbon emissions through electricity generation globally, and nuclear in almost every scenario was a significant part of that. Realistically, to bring down carbon emissions globally, to clean air, especially in parts of the world where air quality is a big problem, right? Again, you look in big cities in China and India, air quality is a significant issue. So just to clean the air where tens of millions of people are living, nuclear has to play an important part of that. And I think there's also this misconception out there that it's mutually exclusive with renewables. That's not the case, right? Nuclear can provide that 15 to 25% baseload CO2-free source, and you can have the rest in a perfect world. You can have the rest as in the form of renewables or even clean natural gas, right? So, I think there's that notion that it has to be one or the other. We have to get rid of that, right? And we have to understand that energy and electricity diversity, much like managing a portfolio of investments, is important. You want to have that diversity. It benefits the people, the local economy. It brings costs down, and it provides grid stability.
It's fascinating because not only is the narrative on the bear case, I personally think, long in the tooth and dated. And I was talking before you came on the podcast, I was talking to listeners about how I love investing at inflection points because oftentimes, especially in industries where there's been an elongated bear market or bull market, you tend to, the narrative takes over and it overwhelms the fundamental changes that are taking place. And nowhere do you see that more than in deeply cyclical industries. And when I think about the uranium space, here's an industry that the all-in cost to produce a pound of uranium is about $50 a pound, give or take. Yet the current spot price is about $23 a pound. And if you think about just economics 101, and you didn't have to go to business school for this, if I make something for 50 and I sell it for 23, I can't be doing that very long. So as I mentioned, right? So I can't stay in business. So post Fukushima in 2011, we saw a surplus of uranium in the world market. Now, because of these prices, it's causing producers, uranium producers, to take production offline and to balance out the difference between supply and demand. And one of the things that makes uranium somewhat unique is that the contracts that the nuclear power plants buy uranium on can last 7 to 10 years. So for many years post Fukushima, they didn't have to take production offline because they were working off uranium prices that were significantly higher. And they were anticipating the Japanese bringing their reactor fleet online sooner. So it wasn't until this harsh reality of $50 to produce and now $23 to sell that it causes suppliers to react. And what we've seen is the two largest uranium producers in the world, the country of Kazakhstan, which is 41% of the market, and Kazatomprom, the state-owned company, about 25% of that 41. And Cameco, the Canadian uranium behemoth, at about a 22% share. They've gone through major production cuts. So can you talk about what you think the impact of these cuts will be on the supply-demand dynamic? I personally think we're in a meaningful deficit right now. Just for a way of education to listeners, and I'll let you get to your answer. The world uses about 180 million pounds of uranium per year, and it produced, going into the end of 2017, about 150 million pounds. And there have been production cuts that could take that down to about 125 to 130 million pounds. And the gap, right? So there's a shortage, and that gap is filled by secondary supply, which comes from different sources. And I won't bog down on the details, but that's starting, as these production cuts flip on its head to where I think the world is in a deficit right now of uranium supply, both primary and secondary. So can you talk about, Jordan, from your perspective, what's occurring right now as these dynamics take place in the marketplace?
Yeah, so you look at the recent cuts, in particular Cameco and Kazatomprom last year, and these are significant developments in production cuts, right? So this time in 2017, you had the initial announcement out of Kazatomprom, a 10% cut, and as you highlighted, Kazakhstan and Kazatomprom being the state-run uranium mining company, the largest producer globally, based in Kazakhstan. They control and produce about 40, just over 40% of global primary mine supply. So they really are the swing producer, if you will, in the market. And then we saw just in the last few months, and this is, I think, as you point out, that inflection point. We've now seen that, and we'll see the aftermath of that over the coming year or two here. But you had Cameco, which is the largest publicly traded uranium company based here in Canada, shut down their largest, richest uranium mine at McArthur River in the Athabasca Basin. That's about 15 million pounds. That's going to be going offline here, or about 10% of global primary mine supply. And then shortly thereafter, Kazatomprom came out with another announcement that they'll be cutting 20% over the next 3 years. So that's in 2018 about call it 10%, or just under 10% of global production. So these are major cuts, right? These aren't marginal producers and smaller mines going offline. These are the largest and lowest cost mines that are being shut down, and it's as you pointed out, it's creating now in 2018 what appears to be a pretty significant supply deficit, and going forward, we know with Cameco in particular, they've announced a 1-year shutdown, but in all likelihood, you'll see that continue on until the price recovers. Simply put, these companies cannot make money selling at these prices. And mining companies, as you're well aware, these are non-renewable resources. Once you mine a pound of uranium, it's gone. It's out of the ground. It's no longer there. And so if you're mining your lowest cost reserve, you're basically burning through your asset base at a loss. And so these companies finally are now making the hard decisions to not produce, to leave their pounds in the ground, wait for the price to recover. And I think it's also noteworthy when you look at both Cameco and Kazatomprom. Here are the world's two largest producers, collectively accounting for over 60% of global primary mine supply. Well, between the two of them, they've announced what amounts to in 2018 over 20% cut in primary mine supply. So, they're not playing around. They are obviously out there right now trying to rectify this market, trying to bring balance back to this market, and they have the ability, given that collectively they're almost 2/3 of primary mine supply globally, they have the ability to force that price higher. So if you look at, again, getting back to the cost curve here, and I think this is also a key highlight, these mines, they're shutting down, the production they're curtailing is at the low end of the cost curve, right? And as we know, the average global cost of production, $45, $50 a pound. Most production is well underwater now at the current spot price of $22, $23 a pound. Well, the mines that are being shut down aren't at the high end of the cost curve. These are in the bottom, the lowest quartile of that cost curve. And so it's not, again, the higher cost marginal producers that are going offline. It is the best mines, the lowest cost, the highest quality deposits and mines that are being shut down. And so what does that mean going forward? Well, I think you're going to see more and more cuts over the coming years. We talk about these higher price contracts. A lot of uranium, a lot of material historically, most of it's traded on these longer term contracts, 7-10-year contracts that mining companies have with utilities companies. And a lot of these contracts are priced currently at much higher prices, allowing these higher cost producers to continue producing. Well, we know that over 60% of them expire in the next 5 years. You also have to factor in usually what is about a 2-year lead time to enrich and fabricate the fuel. You can't simply put yellow cake, which is what we produce, what we mine, into a nuclear reactor. There's a process in between where you actually have to enrich and fabricate the fuel. So that takes a couple of years. So we know the majority of these contracts, higher price contracts, expire over the next few years. So that means that the utilities companies have to come back to the market. They have no choice. They have to come back and they have to start contracting. And that's really, I think, what will be the key driver here in over the next few years is when these utilities do finally come back. There's been complacency over the last few years because there has been a supply glut, but that's changing now. We have a significant supply deficit shaping up this year. We have contracts rolling off, which will mean, as I pointed out, higher cost production will not be protected over the coming years by these higher price contracts. When they roll off, higher cost and marginal production will have to shut down, much like we've just seen at McArthur River, much like we've just seen in Kazakhstan. These mines, these higher cost mines in Australia and Africa and other parts of the world won't have a leg to stand on unless the price increases significantly. So one of two things happens. Either the price moves up, $40, $50 a pound, they're able to negotiate a higher price contract, a new contract, or they shut down production. If they shut down production, that'll be bullish, that'll be positive for the price going forward, less supply, and as the demand continues to grow, we'll see that market come back into balance, right? So it is very much an inflection point. It to kind of put it all in perspective, these recent production cuts, you just take McArthur River. That would be equivalent to Saudi Arabia shutting down most of its oil production. I mean, if you don't think that that's going to have a significant impact on the oil market, you're out to lunch, right? So that's just that's the gravity of the situation. Is you have these aren't minor cuts; these are major cuts at low cost mines, and you're going to see that, I think, over the next couple of years force a higher uranium price. It's also worth noting, as you and I have talked about, Kazatomprom is planning an IPO this year, JP Morgan leading that. So, going to the market right now when you don't really have any assets, any mines, as the lowest cost producer, you don't have any assets or any mines turning a significant profit. That's not good. And so there's all the incentive for them to go out there and, again, drive higher uranium prices through supply cuts, get the price of the commodity where they need it so that they can take a part of that company to market here over the next year.
There's also something else that's occurring, Jordan, with Kazatomprom, which for years there were money transfer laws that were in Kazakhstan. And if you pulled something out of the ground, you had to sell it into a market where there's a publicly verifiable price. And that publicly verifiable price for most commodities is the spot market. But as you talked about earlier, the contracts are long-term contracts. So the spot market is a smaller component of the market. So they were, as the market was under pressure post-Fukushima, they were pulling it out of the ground at lower cost, selling it into a market that was pretty thinly traded, which caused the price to keep going down. But now, coincident with them wanting to go public in the latter part of 2018, they did something that they had not done before, but most major commodity producing companies have, is they established their own sales and marketing arm, which means they can actively trade the commodity. And they set this arm up in Zurich, Switzerland, that opened just a couple of months ago, where now for the first time, rather than having to pull the commodity out of the ground and sell it in the spot market or to a utility right away, they could now sell it to their subsidiary, who can now pool that inventory of uranium. So for the first time, the largest player in the marketplace can become what I call a swing seller of inventory into the market, meaning they don't have to sell it into the market. So from my standpoint, that is a strategic move that they did that really can change the balance of power in the uranium market. The other thing I find interesting too, Jordan, is you had touched on, we talk about the low cost production. We talk about the production shut-in. So one of the things that I did is I went around and I looked around the world for every prospective uranium mine that could come online over the next several years. And with the exception of a smaller one that's coming online in Spain, and a handful of others that are really not big enough to matter, that they could bring 1 million or 2 million pounds on at lower cost. But the big ones that could come on and have a meaningful impact on supply need $50 uranium. Now, there's obviously there's one up in the Athabasca that's a huge find that it's low cost, but you're talking it's not coming online for 7 or 8 years from now. So that will be well past this cycle of purchasing by the utilities. So for new production to come online, the incentive price needs to be at least $50 for these uranium projects to even be considered. And then once that happens, it takes years to build these mines. So as the utilities are coming into the market, and they need to contract, you've got the producers shutting down production, and you have no new real meaningful production coming online unless the price of the commodity goes up 2.5, 3 times. So if the commodity goes up 2.5, 3 times, the price of the equities have the potential to just go parabolic from there. So it's a fascinating time right now, and I know it's one where it just requires a little bit of time, from my perspective, a little bit of time, a little bit of patience, and just kind of ignoring the existing narrative that's out there. I want to flip gears. Let's talk about Skyharbour. So you're in the Athabasca, where the saying goes, "Grade is king." So if you could frame the Athabasca for investors and listeners, and if you could talk about why grade's important. And by the way, folks, grade is king and grade's important. There are other lower grade uranium deposits around the world that could be very profitable, but there's, up in the Athabasca, there's the saying grade is king. So Jordan, frame that for us. Talk about the Athabasca, and then we'll drill down a little further, no pun intended, into what you guys are doing.
Yeah, absolutely. So as I pointed out earlier on, it is the highest grade depository of uranium in the world. I'm not a geologist. My head geologist has been working up there for 40 plus years. His name's Rick Kazmersky. We call him Radioactive Rick. He's found a lot of uranium in his day. He actually was the exploration manager at Cameco for many years, and built and sold his own uranium company, which is exactly what we're looking to do here at Skyharbour. But you essentially had a very unique set of geological events and circumstances that basically created the plumbing, if you will, for these very, very high-grade uranium deposits, multiple geological events that allowed the fluids to come up. And so you had several mineralizing events, right? So you can think about it as, instead of having one or two events that brought the fluids up, brought the uranium up, in some cases you had 4 or 5, right? And so it basically deposits continuously high-grade uranium, right? And so you get these incredibly rich deposits. So, that's unique to the Athabasca Basin. I mean, if you look at the average grade in the Athabasca Basin, to call it about 1.5% to 2% uranium, the average global grade, when you look at deposits across the world, it's about 0.1%. Right, so we're talking 15 to 20 times the average grade, right? And so when you just think about the economics of actually mining, it makes a huge difference. You're now mining on a per ton basis very valuable rock. So you think about your costs that go in to actually get that ton of rock out of the ground, and what value is contained in uranium. As I said earlier, these are actually the richest and most valuable type of mineral deposits out there. You get also in some cases you'll get gold, you get copper, you'll get lots of other minerals in there. But the uranium in a lot of the deposits in the basin, the ones that have been mined or are being mined, is so rich that you just even have, it's not even worth having the circuit for the other minerals. You're just going after the uranium. So it's very unique. It's the only place in the world with those kinds of grades. That brings your mining costs down. As far as we're concerned with Skyharbour, we're an exploration and early stage development company. So what we look to do is go out there and find the next big high grade uranium deposit. And on our flagship project, we have high grade mineralization. We're delineating a resource. As I said, it's unique in that it's shallow. A lot of these higher grade deposits in the Athabasca Basin, you look at McArthur River, Cigar Lake, where Cameco's mining right now, they're 500-600 meters deep, so they can be quite deep, right? At Moore, which is our flagship project, the Moore Uranium Project, we're finding high-grade uranium mineralization at about half that depth, around 260, 270 meters.
And could you explain for listeners, Jordan, could you explain for listeners why what the difference is when you go shallow versus deep?
Why?
So
I mean, simply put, as you can imagine, when you're going to mine or deeper down, your costs go up, right? The infrastructure is more expensive, and if you're shallow enough, then you can even look at an open pit scenario too, right? Interestingly, in the Athabasca Basin, and for these higher grade deposits, there's new technology being developed right now that is actually looking at in situ mining, similar to what you see down in the U.S. and in Kazakhstan with ISR, right? But instead of pumping down a solution, what you're looking at doing is simply pumping down water, jet boring it, which is actually how they mine at MacArthur and Cigar. You can think of it as a big power washer, right? And the rock, the high-grade uranium is quite soft, so you can actually break it up by jet boring it. And so getting back to this new extraction technique that's being developed, they're looking at actually mining high-grade, shallow deposits in these small pods by simply just drilling a borehole down, jet boring it, and then pumping the high-grade uranium and water mixture up to surface, shipping it to the mill and processing it to produce yellow cake, to produce the end product. So that's a perfect example of new technology and extraction techniques being implemented, which will bring your costs significantly down. And it's not just costs. I think it's important to highlight, permitting and environmental impact, right? Permitting is very tricky, as you can imagine, in any developed country, and especially for uranium deposits. To permit a uranium mine doesn't happen overnight, right? So that's why, you see some of these big new deposits that are in the pipeline. They can't turn on overnight. The permitting itself, it takes time, right? So, the permitting for a lower impact, especially, a lower environmental impact mine, in theory becomes a lot easier, right? So I think that's important to note. So, getting back to Skyharbour and what we're focused on is at our flagship Moore project, we continue to drill and discover new high-grade uranium mineralization relatively shallow. But it's exciting because the project itself, which we acquired about a year and a half ago, was a project that had the initial discovery, high-grade discovery made on it back in the early 2000s. And a lot has changed, actually, in the last, call it 15, 20 years when it comes to how you actually go about finding and exploring for high-grade uranium in the Athabasca Basin. One of the things that we're doing currently right now is using drones, UAVs, to go out and find new drill targets, right? So you use what's called geophysical programs. This allows you to see, to a certain extent, what's below the surface. I won't get into the details, but you can use, EM, you can use MAG, and instead of having a helicopter or an airplane fly these surveys where you get more of a coarse signature or imprint, and it can be tough to find, especially when these deposits are so high grade, they're low tonnage, they're small, right? They're small deposits relative to other big mineral deposits that you find, gold, copper, other minerals. So you want to have very fine geophysics so that you can go in and properly target your drilling. And that's exactly what we're doing here, and we think that could be the key to unlocking additional discoveries, right? There's lots of other techniques. You can look for radon, for example. You can fly radiometric surveys, and then there's the geochemistry, the rock itself. You're looking for very specific indicator minerals. There's certain types of minerals and elements that are closely associated with high-grade uranium. So there's a real science behind it, and that's what our team, led by Rick, based in Saskatchewan, that's what they do, right? This isn't just, treasure hunting, drilling holes into the ground. There's a real science behind it. And as far as how that concerns the shareholder investor, think of it as, ROI, return on investment. I like the term return on drilling, right? So when we go out and we raise capital to go and find these deposits, you want to know that each dollar's going as far as possible, right, that we put into the ground. Well, using as much of the science and especially some of these new cutting-edge techniques in the Athabasca Basin, the return on investment, the return on drilling will be better, right? And you'll see obviously that reflected in the share price. So, just to kind of take a step back here, I just want to point out, and I know you're familiar with these companies, but just to kind of give the audience here an idea. If you look at a couple of notable success, exploration and discovery success stories in the Athabasca Basin, you look at NextGen, right? NextGen's gone from a 30 or 40 million market cap 4 years ago to about $1 billion market cap. And as we all know, it hasn't had much help from the price of uranium itself, right? So You've had the price of the commodity chopped in half, yet they've gone up exponentially over the last several years. And that's all on the back of a high-grade discovery and deposit that they found in the Athabasca Basin. You look at Fission, similar type of story, right? You look at Hathor, which was bought out by Rio Tinto in 2012. Again, these are companies that have created significant returns for investors and shareholder value on the back of high-grade uranium discoveries in the Athabasca Basin. So that's exactly the model that Skyharbour's pursuing and that we're looking to execute on. And just one other strategy, though, that we do employ to basically complement that high-grade discovery potential is called the prospect generator. And what a prospect generator does is they go out, they acquire projects, they do a bit of work on the projects, and basically package them up and then look to find strategic partners to come in and fund work, the exploration and development on them, get some cash and stock from those companies as well as they buy in, as they earn in, much like farming out an oil and gas project, right? It's a similar model in that we bring in partner companies. This is what we did with Areva out of France on one of our properties. They're earning in 70% over the next 6 years by spending $8 million. So they fund the exploration. We benefit if they find anything because we'll retain a minority interest. We get news flow, catalyst from it, but we also get some cash as well. So we actually generate some revenue on a year-to-year basis. So we've done that in a couple of instances here on a project called Preston. One deal we have with Areva, as I mentioned, out of France, an $8 million deal there. And then another deal with a company called Azincourt. Similar structure. They're earning in 70%. It's over a 3-year period, $3.5 million in cash and exploration expenditures, and we've been issued some shares of the company as well. So it's really a dual-pronged approach. Your biggest catalyst is always the high-grade discovery and resource delineation, which we're focused on it more. We're drilling there here, our winter program, which will be underway shortly, about 5,000 meters of drilling. But we have multiple irons in the fire with other partner companies funding exploration at our other projects. So you'll see lots of news flow, lots of catalysts. And look, we're still in the market right now, looking at projects, looking at other opportunities. We're still in, as we've talked about, a tough market. I think it's bottomed, but it's been consolidating here, and I think we're at the very, very early days of a recovery. So there's still some opportunities, incredible opportunities out there to continue building the project portfolio, continuing to capitalize on a otherwise difficult market, almost a distressed asset scenario, and so we are out there continuing to look for those opportunities as well.
So for listeners, I just want to frame where Skyharbour fits in the uranium mining landscape. So you have producers like Cameco who, while they still do some exploration, they are producing uranium out of mines around the world, in different countries in the world, and they're generating some cash flow from that. So that would be an example of a producer. Then you go down to what's called a near-term producer, and that might be a uranium company that has a lot of pounds of uranium in the ground. They've done a lot of drilling, and they are waiting to go into production. They may need a mine to be built. They may have mothballed their mine because the price of uranium is too low, and that's near-term production. And then there's the exploration companies, and that's where Skyharbour fits, where they're out looking, putting drills in the ground. There's a flat piece of land, or maybe not so flat, but they're drilling down,
it's
looking.
Pretty flat up there.
It's pretty flat and cold. They're looking to find a bunch of uranium in the ground, and Jordan does it where he either finances it himself, the company finances it itself, not Jordan himself, but the company does, or the prospect generator model where he's using OPM, other people's money. They get less of the upside, Skyharbour does, but you're not having to expend the capital to do that. So
exactly.
Right. So that's kind of how the uranium landscape of mining companies works. And so, Jordan, where do you go? You talked about at Moore Lake. Can you talk about real quickly just the drilling programs that are coming up and what investors could expect to see over the next 6 months?
Yeah, absolutely. So as I mentioned, with the dual-pronged strategy of drilling at our flagship project, Moore Lake, which will start here shortly, again, about 5,000 meters. And if you look at the program, two programs we ran last year, both the winter and summer drill program, high-grade drill results do translate to a higher share price, right? We saw that in February and March of last year, where we hit our 52-week high. That was really on the back of high-grade drill results. So we will be starting that back up here shortly, and we as I pointed out earlier, it's high-grade shallow mineralization, but we are using some new techniques, kind of a new look on the project to go out and find more high-grade. Quite interestingly on the project, actually, most of the recent high-grade discoveries, and I won't get into too much geology here, but most of the high-grade discoveries recently have been found in what's called the basement rock underneath what's called the unconformity. So this project is really only been explored and drilled down to the unconformity. They haven't looked much lower than the unconformity. So there's a lot of blue sky. There's a lot of discovery potential a bit deeper down in that basement rock. Next Gen, Fission, the Griffin deposit at Dennis, and these are all new discoveries that are basement hosted. So it's a project that's had a lot of historical exploration. There's high grade there. We know the geology's there for a large high grade deposit, but to be honest, the knowledge back 20 years ago, the way that they believed that these high-grade uranium deposits were formed, and the way that they went about the exploration, that's changed here in the last 15 or 20 years. So that's exciting. We can go test some new theories, and I think we'll have success with that. And then the prospect generator model allows us to benefit from additional news flow funded by and exploration funded by partner companies. So just in the next several months, we're actually going to have our busiest exploration season ever since we started the company about 4.5 years ago. We have our drill program and news flow from that. Areva is going to be drilling over at our Preston project. This is over on the west side of the Athabasca Basin. There's the east side where the current infrastructure and mines are, and our flagship Moore project is, and then the west side's where some of these recent discoveries have been made by NextGen and Fission. So Areva's working at our Preston project over there, drilling there, starting shortly, about 4,500 meters that they'll be drilling, so we'll benefit from that news flow. And then Azincourt is also carrying out exploration. So you get a lot of news coming out of the company, the potential for catalyst to drive a higher share price over the coming months, and then I think getting back to more of a macro theme. I do really believe we're at the early stages of a recovery. I think this year is going to be a good year for uranium investors, and any company that is looking for or developing uranium mine or producing uranium, obviously, one of the main drivers, one of the main catalysts for share price appreciation is the underlying commodity. And as a junior company, as a smaller cap company, we're leveraged to that price, right? So when you see the price of uranium start moving up, you're going to see significant returns on a smaller or micro cap company. And there's not many of us out there, as you pointed out early on in our chat here. We've gone from over 500 publicly listed uranium companies just over, call it 10 years ago in the last uranium boom to less than 40, and a number of those, especially on the small cap side, are relatively inactive, haven't been able to raise capital. We've been fortunate. We have some notable larger shareholders, as I mentioned, Denison Mines, which is one of the largest publicly traded uranium companies, is our largest shareholder and a strategic partner. Dave Cates, who's the president and CEO of Denison Mines, is on our board. So again, a very close working relationship with them, and a couple of funds and call it smaller resource funds and family offices over the last year and a half, 2 years, as our stories evolved, have written big checks for the company and have financed us and understand the narrative around not just the uranium market, but also what we're doing at Skyharbour specifically. So we have a very strong shareholder base, and that's also an important ingredient for success, along with the management team, and on the management side, as I pointed out, my technical team based in Saskatoon, led by Rick. I mean, Rick's a 40-plus year veteran. He's found a lot of uranium. He was a senior geologist at Cameco for many years. Dave Cates, who runs Denison. Paul Matizik is a strategic advisor, shareholder of the company. Paul just recently sold a company, Lithium X. He's built and sold actually now in the last 12 or 13 years 5 mining companies, and one of them was Energy Metals Corp, a uranium company that he started in 2004 at a $10 million valuation and sold it 3 short years later for $1.8 billion to Uranium One. So, that's a perfect example of what you can see happen in a rising uranium market, and as we all know, at the tops and bottoms of markets, there's usually consolidation in the sector. That's exactly what happened in 2007 when we saw the price of uranium break through $130 a pound. You had a lot of M&A, and a lot of people made a lot of money.
So, Jordan, just for those those listeners who are not natural resource investors, which I assume are many of them, so we talked about the different types of uranium mining companies and exploration companies. We talked about you having some flat land in some really cold area of the world up in the Athabasca Basin. You're putting drill bits down in the ground, and you're coming up with these holes that are showing some high-grade uranium. How does that translate to educate our listeners? How does that then translate into the next phase to say, hey, this is how much we think we have in the ground, when they could really, people start to really get their head around what you're doing? And again, it's for the lay person who's not a natural resource investor, but might recognize that uranium presents a really interesting value proposition right now, the uranium industry, and as they're looking and educating them. So we'll just quickly walk us through that process, that all these drill holes that are out there, and if they look at the presentation, they'll see a lot of color and charts and stuff that might not make too much sense to them. How do we break that down to sitting around, having a beer at the bar, and they walk away saying, yeah, I kind of get what that is? Sure.
Yeah. So, I mean, I guess a simple analogy is, think about a startup tech company, right? We're out there looking for and exploring, developing, and looking for these high-grade uranium deposits. Well, think of Facebook early on, right? I mean, it was a website, social media platform, but it took a couple of years to develop, and obviously we all know what happened there, right? So just to kind of use an analogy with a different sector, different industry, what we do, we're early on in the life cycle of a mining company, right? We go out there and we go and essentially find the deposits, and what we are ultimately looking to do, and the company I was previously with was a company called Bayfield Ventures. It was a gold company which we executed this strategy with, where we found a high-grade deposit and we ended up selling to a larger mining company, right, called New Gold. That's kind of exactly what we're doing here at Skyharbour, what we're looking to do, right? We want to go and build a company that one day a larger mining company will, or who knows, it could be a larger mining company, could be a government, a state-owned enterprise. There's a number of possible buyers at the end of the day, but ultimately we would look to sell the company, and that's where the shareholders obviously benefit and make lots of money, but you want to obviously time that with uranium market and the cycles. And you also want to do that on the back of exploration success. So you go out there, as we're doing right now, and find new deposits, find new high-grade mineralization, which in itself will create shareholder value, will move the share price, right? But when you get to a point where you have a resource, you've delineated it, you, let's say, have we already have this at a couple of our projects, right? I mean, these, between Moore Lake and Falcon Point, we have two projects that have had tens of millions of dollars invested in them, multiples of our current market cap right now. So these aren't just, grassroots projects, right? Falcon Point has an I-43-101 resource on it.
Right.
And Moore Lake, as I mentioned, we're delineating a high-grade resource as we speak right now. But what we look to do is basically advance these projects to a stage where it becomes attractive for a larger company to come in and, as you pointed out, develop, right? Near-term production, actually develop, build the mine, and then produce, right? Our expertise, our technical team, and the people running the company, they're best suited to finding these deposits, delineating a resource, de-risking those projects and those deposits as much as they can, and then ultimately looking for a larger company to come in and develop it. And I think it's also important to note, if you look at the life cycle of a mining company, right? So you start with the earlier stage exploration and prospecting, you make a discovery, delineate the resource, you develop it, and you produce. If you look at it from an investor's standpoint, right, the best returns, the highest returns are always at the beginning, right? The discovery process. Now, it's obviously higher risk, right? There's no argument there, right? But it's high risk but high return at the earlier stage, and that's what we're really looking to accomplish: is go out there and find new resources that can be low cost, that are high grade, shallow, low cost deposits that one day a larger company is going to come in and want to acquire, going into a new uranium bull market. So that's, in a nutshell, really, to, I guess, explain it to the average investor. There are a lot of similarities just from a high level with other industries, right? Mining, much like tech, much like pharmaceuticals, much like any industry out there. It's these are the smaller cap, they're high risk but higher return companies, right? And I do think, though, getting back to the broader uranium market, you do have one thing going for you right now, which will benefit you as a shareholder, as an investor, is that if you're coming into a new bull market, a new cycle with uranium, which we've talked about throughout this conversation, that will be one of the main drivers of the share price and share price appreciation over the coming years. So you have kind of two big catalysts that are coming up. Obviously the company specific catalysts, finding new high-grade uranium, having exploration success, which we're working on right now, both on our flagship project Moore, but also with our partner companies that are other projects. But then when you see the rising tide, and then when you see the uranium market really start to get some traction, you'll see significant increases in valuations. I mean, we just look at the previous cycles, right? There was, from 2002 to 2007, there were some major returns on almost every company, to be honest. But you look at Paladin, for example, that was a company that went from 10 cents to $10, right, in a rising uranium market. As I pointed out, Paul Matizik, a strategic advisor of ours, his company Energy Metals. There's lots of examples. So it's timing's important, but you also want to make sure you're picking the right companies. When there's only a handful of companies left to pick from, it makes that job a lot easier. And you've had a consolidation of not just projects and assets in these few remaining companies, but also people, right? Management, technical teams. So you have companies now that are, built for success as the market improves.
That's great stuff, Jordan. I can't thank you enough for your time. I appreciate it. I know you're out in Vancouver, so you're getting up. You were getting up early this morning for the call, and it was great. I really appreciate it. I think you're doing a lot of interesting things there, and I always enjoy talking uranium with you. So I'll give you a call, and then we'll get you back here on the podcast as time evolves, and we'll keep investors and those interested up to date on the Skyharbour story.
That'd be great. Yeah, anytime.
Thanks. Talk to you soon. Well, I hope you enjoyed the conversation with Jordan Trimble, the CEO of Skyharbour Resources. We were talking uranium. It's an industry that I am very bullish on right now because of the supply deficit that I see forming. And at the depths of a bear market, I think there's just tremendous upside from a risk-reward standpoint. What I call it's asymmetrical. It's lopsided, the risk versus reward. And we're going to do an education segment here because this is something I want to, in my hope of laying the playing field for the regular investor, not the professional, but the regular who does it himself at home or herself at home investor, I want to talk to you about how investment opportunities like uranium and other industries, whether you're looking at tops of markets to bet against it or bottoms where you're betting for a turn, how you have a big advantage that you may not know against professional investors. And I earlier in the podcast, I talked about Gretzky and saying he skates to where the puck is going, not where it is. Let me explain how that translates to the world of investing and how it translates into the differences between a professional investor and an individual investor. So let's talk about what does a professional investor have, right? What are the tools they have, right? And you hear people say, well, it's an unlevel playing field. They do this every day. They're professional. Absolutely. Let me give you an idea of some of the things that they have at their fingertips, most of them, that you don't, likely. So if you're a hedge fund manager, you're an analyst at a hedge fund, you probably have a Bloomberg machine. That's going to cost you about $24,000 a year, maybe a little bit more, right? And Bloomberg is an information service about all things financial. It's really invaluable to an investor. They may use something called Capital IQ, which is a tool that provides detailed financial information on companies and industries. It looks at fixed income. It gives you mergers and acquisitions information. It gives you just it's voluminous amount of information, and that costs about $7,000 to $10,000 a year. And then if you're a hedge fund that has some capital and you have a decent amount of assets under management, you might hire a consulting firm, maybe 50, 100, 200,000, maybe more per year to go out and find you experts in any given industry that you can talk to. Think of them as professional matchmakers. So the hedge funds want to learn what's going on in an industry, and they'll call a consulting firm and say, we need to speak to an expert in this industry. And they call back and say, we got somebody, and there you go. Now you're talking to an expert. I'll save a whole other topic for that because when they all start talking to the same expert, it doesn't really do much good, but that's for another day. And if you are getting research from an investment bank as a hedge fund manager, analyst, a mutual fund manager, you're paying minimum trading commissions for that. And typically to get access to these big banks, you need to pay at least $50,000 per year. And then as a professional investor, you have company access. So you can call up and tell them you manage a fund or you're an analyst at a fund, you have a lot of assets under management, and management teams want to meet with you because they want you to buy their stock. So while federal regulations prohibit management teams from divulging any information to anyone that they don't disclose publicly to all people at the same time, it really does mean a lot to be able to sit in front of a management team, sit and have a meal with them, sit in their offices, and just get a feel for who these people are as individuals. And that's invaluable. And so now you look at what they have and you say, okay, well, geez, I'm at a disadvantage. Let me tell you why that doesn't matter. So let's take a look at performance. Let's look at most mutual funds. Let's use them let's pull them out as an example. If I look back over a 5-year period at U.S. mutual fund performance, and this goes through June 30th, 2017, the information I was able to find, but it's close enough. In large cap mutual funds with the S&P 500 as the comparative index, 82% of them underperformed. If I look at the mid-cap universe, 87%, and the small-cap universe, 93% of them over a 5-year period. And when I look at the numbers over a 3-year period, it's the same thing. So think about that. All of these great tools, all of these really smart, well-educated people, the performance sucks. I mean, it's dreadful, right? Okay, now let's turn our eyes to the industry I come from, the hedge fund industry. right? So so a mutual fund, by the way, they get paid a percentage of assets under management. It could be 1%, 1.5%, 0.75%. It's all over the place, but they get paid just to manage money. Let's turn our attention to the hedge fund industry. Let's take a look at global hedge fund performance versus the S&P from 2008 to 2007. Now, when the market went down in 2008, the S&P was down 37%, and the Eureka Long Short Hedge Fund Index was down 19, right? So the hedge funds outperformed by 18 percentage points. That's good. I'm going to take you through 2009 through 17. This is the difference in performance of the index versus the hedge funds. We had -1%, -4%, -8%, -8%, -16%, -10%. They outperformed the index by 2%, and then -8 and -9. And what that means is the hedge funds are underperforming the S&P by a large amount, right? So again, all these professionals, all these really bright people, highly educated, with all their expensive research tools, they don't outperform the S&P 500. So how is that possible? It's one word. It's called time. And then we're going to expand upon that. For an individual investor, you have the opportunity to arbitrage time, to take advantage of time, right? So if these professional portfolio managers are under such tremendous pressure to perform, if they underperform, investors take their money out the door, right? If you run a mutual fund, every single day, at the end of that day, your price is shown to the world for the world to see. And one thing I've learned from investing for 20 years as a professional is it is nearly impossible to outperform the market or your peers if you're doing the same thing as everyone else. The fancy term for outperforming the index is called alpha. Right. Now, the challenge for mutual fund managers is they're benchmarked against both the index but their peers as well. So finding investments that are going to outperform is about anticipating where the puck is going, not where it is. Right. So you have to think into the future. The problem is when you're benchmarked as a professional, if you're thinking out into the future and all of your peers are not, there's a chance that you're going to underperform, because if it was so obvious what the future would look like, it would be priced into the stock. So you have to have real great courage and conviction to make that bet. And when the assets could walk out the door, if you are underperforming your peer group, you're likely not going to make that bet. And in cases of industries like uranium and other blown up sectors where the narrative is so extended and long and stale and overwhelming the changing fundamentals that are taking place, it's going to take a longer time for that to turn until the fundamentals jump up, hit investors over the head and say, look at me. And then all of a sudden it's Katie bar the door into the investment. You as an individual investor, you don't have mark to market every day for the world to see. Assets are not going to walk out your door that are the lifeblood of your business. You may be down a little bit. If you get in early to an investment and you size it properly and you recognize that you're early to the investment and you scale into it. So if you were going to devote 2% of your portfolio and you put portions of that in and you bought a little bit on the down, if you've done your work, if you have conviction, and if you size them properly, time is your friend. It's not your enemy. It's the exact opposite for professional investors. I talk to friends of mine in the hedge fund industry, and I talk to them. They know that I'm a widely followed uranium analyst, and I speak a lot publicly on it, and I have access to industry participants, and I lay out the uranium story for them. And they want to go there. They want to get there, but they need to perform today, tomorrow, this quarter, next quarter, or else if they don't, those assets walk out the door. So they don't have that luxury of time. But the beautiful part about it is the uranium market, any other cyclical market where fundamentals are changing, the market doesn't care about the professional managers. The market does what the market's going to do based on supply and demand. So you have a tremendous opportunity to arbitrage that difference between a professional money manager who doesn't have the time, and you get to sit there and buy and be patient. And when they come in, especially in an industry like uranium, it's crazy. Think about it. 500 companies down to 40, right? So not only are we entering a period of uranium shortage in the world, there's an equity shortage so when you have the uranium market is big, it's meaningful. It's 12% of world electricity. The last time the cycle was enormous when stocks were up many, many multiples. Well, now when the professional investor finally gets hit over the head and sees these dramatic improvement in fundamentals, there's not a lot of stocks to buy. So there's also an equity shortage. And when you have less of something, prices go up. So take advantage of time, use it as your friend, be patient, understand that you might buy it, it might go down for a little bit. Now, if the fundamentals change, that's when you say, okay, going back to what I said earlier in the podcast, it might be wrong here. And if we're wrong, we've got to get out, right? But if the fundamentals keep improving and the stocks just haven't caught up yet, for me, that's music to my ears because I get to add a little bit more. So anyway, that's my educational segment on time arbitrage. I want to thank you for spending your last hour and change with me. It was a pleasure to do my first podcast. I hope you enjoyed it. You can get a hold of me. You can send me an email at mike@curzioresearch.com. I look forward to the next podcast. Thanks. Take care.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.